This is a continued version from my previous uh, video regarding the basic concept of this home loan calculator, how they calculate the interest rate and how much interest that you pay over the years, and then the mechanism of how the bank's home loan works. Okay, today I will go into more critical aspect, which is the trick that banks use that actually favoring the bank, instead of the consumer, and how much you can actually save interest by finding some way to offset your home loan faster. Okay, first of all, I want to go to the very fundamental aspects, okay, which is called your finance budgeting, okay, because everyone they have their own income as well as their expenses, and you must always know that you must always have saving, meaning that you always spend less than what you earn. So given this is the installment, like I mentioned earlier, this is the default setting, 500,000 of property over 35 years with 5% interest, okay? So you're actually paying 2,271 interest per month. So I presume your income, say you have 10,000, and probably you need to spend another 5,000 on car and your grocery and food and so on, or perhaps your other expenses for a family. And I do believe you can actually set 1,000 extra, perhaps to for vacation, for expensive phone, for expensive clothing, for a better lifestyle. Okay, what happens if you use the 1,000 extra to offset your home loan instead, meaning you pay 3,200? Okay, we'll see what happens. Okay, just by you sacrifice your car, perhaps you buy a cheaper car or use a different lifestyle. Okay, so if you see, you actually pay 953,000 apart from the 50,000 down payment that you paid earlier. Means you pay as much as 1 million over the 35 years, for your capital as well as interest. Okay, so now I will show you the way how you can cut down a lot of your interest. Okay, well, I just give you an example. Let's say I want to make it very dramatic. Say you take a 100 years loan. Okay, how it will happen? Perhaps you will pay it over few generations. Let's say you take 30 years to pay off a partial of your housing loan until you age 65, and then you pass the installment to your next kin. Meaning the house normally you will, after you die, you pass to your son, right? So your son will keep on paying, and then you pass it to your grandson and so on. So let's say 100 years over 5%, the same rate here. Okay, actually you only reduce. Earlier, if you see, if I put it back to 35 years, right, 1887 and 2271. Okay, 2271. Okay, I just use a calculator, and 2271 minus 1887. So actually you only pay $384 less. But what happened is, you can see over the 100 year, you're actually paying 1.8 million of interest apart from your 500,000 house. I mean, this is a loan. So you're actually paying 2.3 million for the house, for 450,000 loan over 100 years. So meaning that the longer you take the installment, the more interest is being charged. And you see at this chart, right, you can see your capital, this is your balance, or this is your principal. You see, you take almost beyond 30 years, only you start increasing the capital repayment, meaning the first 30 years is like not moving. If you see at the principal, right, this is the interest that you pay. You see, let's say you are the first generation, you pay until 35 years. You only manage to reduce 14,600 while you already pay 700,000. Meaning you pay nearly near 800,000 of installment over your lifetime, and yet only reduce 14,000 for interest. This shows that it doesn't matter how much you loan. You loan actually is not a big amount of loan, but because your installment is prolonged to a very long period, it's actually favoring the bank. Because why? Because whatever you pay monthly, it doesn't really offset the interest. You see, over the first 10 years, whatever you pay, you only just reduce barely not even 2,000 of your capital. So whatever you pay, you're actually just paying the interest. Same like the idea of credit cards also, which they charge as much as 18%, which I will talk in another video. So they ask you to pay minimum payment, which only offset the interest without reducing the capital, and you end up being a slave to the bank. You keep on paying interest endlessly to the bank without offsetting your balance. So this is the trick that is very much favoring the bank. If you prolong your installment, the length of your installment, and in the end, bank is the one who make the richest. Okay, so now I want to keep it simple. I go back to the 35 years, right? So as earlier that I mentioned, in the initial stage when you want to buy this 500,000 of property and you are able to pay this 2,271, I presume you have a very strong income, meaning like 8,000, 10,000 like that. So if you don't have that income, say you have 5,000, then I would advise you strongly, don't take this, buy this property, because if there is any case that you're unable to work along the way, let's say in the next 10 years or 15 years, then you will struggle to pay off this. And what happens? You have to sell off the house, or perhaps you have to rent it out. So there will be a lot of mess. Okay, so now presumably you have a better income, and I believe you can pay extra 1,000. So what we'll see if I reduce it to 20 years, so it's 2,900. Okay, so if I reduce further to 7 years, okay, it's some way 1,000 extra from your initial installment payment that you should pay. So you see, you can actually reduce from 35 years to almost like half, to 17 years only, 18 years reduce, just by sacrifice your car. Perhaps your 1,000 you'll use to pay like a $2,000 car. Instead, you buy a ordinary 1,000 car, Like for example, Malaysia, we have Proton Saga. Instead of you buy the Honda City or Mazda, you go for the basic Pro Dua or Honda. Okay, so with 1,000 payment extra, meaning that if you pay extra 1,000, right? If you times 12,000 and you times 17 years, so in the 17 years, you're actually paying extra 204,000, meaning that you offset earlier. Of course, you take less time to offset earlier. So you pay extra 204,000. If you look at it, right, in the end of your 70 years, you're actually paying 668,000 instead of 950,000 earlier. So meaning that if you're 950,000 minus let's say 668, so you actually save 282,000 of interest, And then of course when you settle earlier means by the 17 years, okay, presumably like you borrow from say age 30, maybe perhaps you just get married 30, right, until 65. Of course, after 55, let's say you're retiring, you still have 10 years in your retirement time, you still need to pay the installment of 2,200. But now what happened is 30 plus 17, meaning by the age of 47, which is 8 years before your retirement, you already clear off all your home loan debt, meaning that 8 years heading to your retirement, and during the retirement, you got nothing to pay on the home loan. You free a lot of your commitment. So that's the good thing. And also you pay less of, like I mentioned earlier, about 250,000 of interest, so that's save a lot. So if you look at this rate, I feel it's reasonable to pay 200,000 of interest over the 7 years. But if you want to reduce further, okay, say you're paying this, and let's say in the 10 years, okay, if you look at the 10 years, right, what happened if you dump some cash to it? Because in the 10 years, you already pay 170,000, 75,000. So is it worth if I dump further cash, to clear off the debt better? So the answer is no, because in the end, you see, between in the 7 years, the last 7 years, you're actually being charged of 25 and 15, so it's 43. You only charge 43,000 in the last 7 years, but you charge 175,000 over the first 10 years. If you look at the first 8 years, the first 8 years, And this is the last 1, 2, 3, 4, 5, 6, 9 years, okay, 8 and 9. Normally, the first 8 years and the last 9 years, right? Normally, it seems like very balanced, but actually, you're actually paying over near 150,000 of interest, whereas the last 9 years you only pay barely 68,000. So meaning that the more, if you dump the cash in the end, is not worth it, because in the end, the interest being charged is lower, and the principal, being paid off is much better, So there's no okay. If you look at this chart, right, you see your principal will clear off faster at the end, especially after the 9 years. It will take slower, and you can see the interest actually is get much lower after the 9 years. You see, compared to the first 9 years, the yellow line here. Okay, so meaning that if you really have the cash, right, I would advise you to dump it in the second year to fifth year. This is the best, because you see the first okay, you see 3,278, right? If you times 12, right, you pay like 39,000. If you calculate this plus this, right, it's 39,336. That's the amount that you pay for your installment over the 12 months. And you can see the interest and principal is quite balanced out, but it's more on the interest. But as you go further, right, you can see the interest will get lesser, Suppose 22 times 5, you'll get like 110, but it's become 101. So the interest get less, but still pretty high at the first year. So when you dump your cash, let's say you you're age 30, okay, perhaps you will need to get married, blah blah blah. You need a lot of cash here and there, so you cannot pay in the first year or second year. Then perhaps in your third year, when you you cut, you have to really restrain on your spending, especially on cars, or perhaps you want to have your children later or baby later, or perhaps you want to cut down your high-end traveling until your age 38 or 40 like that. So by saving some cash, right, perhaps your wife also can work while she's not pregnant yet, not having a baby. Then with the cash saved, right, you can actually dump, say like on the third year, right, you only reduce from 450 to 395, meaning you reduce 55,000 of your capital. Okay, so on the third year, right, 395,000. What happened if you suddenly dump 50,000? Meaning it become 345. Okay, of course here you pay down payment, so it's become like 345 become 295,000. So of course, if you keep on paying like 3275, right? So now we put it 10 years and perhaps 8 years and perhaps 6 years. Okay, 7 years. Okay, 6.5 years. Okay, around there, perhaps 6.7 years. Okay, 6.3 years. Okay, somewhere there. Okay, so if you see just by the third year, right, just by dumping 50,000 in, earlier, your 17 years, actually, like you pay off the first 3 years, and you still left with 7 years, meaning you actually cut down from 35 years to 70 years and now to 10 years. So after the third year, right, what happened is the fourth year until the 10 years, you actually pay 40,000 interest. So your interest is cut down dramatically. Okay, here, I put it down here, 40,600, right? Okay, if you look back at earlier that I put 17 years, okay, and with the 350,000, because you didn't dump the 50,000 in, right? Sorry, 450,000 here. Okay, 500,000 property. 3,000 or 3,200. Okay, I think there's a mistake here, calculation. Okay, see, your property 500,000, right? You pay down payment, so this is your loan, 450. Okay, so 450, right? 450, but you dump in 50 on the third year. Third year is supposed to leave like reduced by 55. Okay, suppose I minus 55,000. Okay, wait, let me see. 450,000 minus 55,000. Suppose it's 395,000. Oh, sorry, wait. 500,000 minus 55,000. Okay, suppose I think it should be 445,000. Okay, okay. 445,000 because after you minus the down payment, right? Then you should get like somewhere there. So actually, what happened? It will reduce your installment from 3,002 to 2,008. But what happened if you maintain the installment? So okay, what happened is actually you reduce 3 years of your installment period, given that you pay the same installment, which is extra 1,000 from the initial 2,200. So actually, you see, by dumping 50,000 in, right, you're actually still paying a hefty 155,000. Okay, now I put it here 155,000. Okay, but if you look back at the earlier 500k house, okay, earlier, right? Okay, over 17 years. Okay, earlier, right, you're supposed to pay 218,000. Okay, I think there's a miscalculation again. Okay, supposedly by third year, right, you should left with 395,000 of loan. Okay, meaning that 450 dropped to 395. But after you pay 50,000, right, it's supposed to be 345. So 345 supposed to be 345 supposed to be reduction of 95,000. So which is 455,000. Sorry, 455,000. So actually supposed to be this earlier. I calculate wrongly. Okay, so that's why you have to be careful with your maths. Okay, this one let me figure out and I'll come back in the next video. Okay, but given what I say is by paying more installment and also when you dump in the cash, you dramatically save a lot of interest, especially at the beginning of the year. That's the point. Okay, so I would suggest that if you want to settle your housing loan, I suggest that you pay it off early, especially the first 5 years, and not after the 10 years, like say 12 years, 15 years. Then it's not worth it because a big portion of your money actually already offset the interest. So whatever you pay at the later time, right, it probably will only help you to ease your mind, is to worry about the installment, and that's all about it. Instead of you have the cash and you want to splash out for some unnecessary thing. So that's why I would suggest you to pay it off even in the later year, but the best is pay off earlier. Okay, so I will study again on what happens if you dump some cash instead of increase your installment. Probably you choose to dump in cash. And when you dump in cash, right, you will really have to tell the bank that you are paying a lump sum, which is to offset the capital of the housing loan instead of just a normal repayment. So this one also there's a differentiation which I will talk in another video later. Okay, so if you like my video, do click like and subscribe. I will talk more on some idea of overdraft, current asset offsetting your capital home loan using the flexi type of home loan, as well as the idea of what is refinancing, is it worth it, and what is the additional cost that you involve And also we'll talk other things like credit cards, balance transfer, and so on. Okay, thank you guys for watching.